Good morning, everybody. Thank you very much for joining us this morning. Great to have you all on board this morning, and thank you very much to Gravita for hosting this morning. So yes, I understand today, just for the benefit of TMA viewers that are on this morning, we've also got some of Gravita's professional advisor panel joining us this morning as well. So it's not just TMA. For the benefit of everyone on the Gravita panel, just to let you know a bit more about TMA. So TMA stands for Turnaround Management Association in the UK. My name's Johnny Abraham. I'm president of the TMA in the UK for the next 2 years. And we are, in effect, a industry board for professionals working in the turnaround and restructuring sector. So we have a lot of people working in turnaround, lawyers, specialist funders, advisors, independent practitioners, that kind of thing. So yes, if anyone on the Gravita advisory panel is interested in getting involved, please do get in touch. We'd be delighted to speak to you. So I think with no further ado, I'll hand over to Sandy and Daniel, who will tell us a bit more about Gravita and cover off some subjects that can kind of easily be missed at times, especially with the VAT. Yeah, hopefully a very interesting session this morning. Over to you.
Thank you, Johnny. Welcome everybody to this morning's session. So my name's Sandy Cochrane. I'm a VAT partner here at Gravita. I've been doing VAT general practice for over 20 years now, having worked in industry, and do a lot with businesses that need time to pays or need a little bit more input from a VAT perspective to help them, you know, sort of carry on with their businesses in a most productive way. Dan?
Good morning, all. Hi, I'm Dan Rose. I'm an audit and transactional service partner here at Gravita. Worked here sort of continuously now for about 12 years, 13 years. And I sort of wear two hats. So I'm sort of split sort of 60-40, I guess, from the audit to the transactional team. And most of today we'll be discussing the sort of transactional work that I do from a financial due diligence point of view, to valuations, contentious and non-contentious, and advising companies in such matters as sort of business financials, cash flow forecasting, and sort of overall strategy.
Thank you. And I think, you know, for us, Gravita as a firm, we are green there. We do a lot of advisory for personal clients, for business clients, very small businesses up to large businesses. And we also work with DFK International. We have a lot of our clients and prospects that have that international angle to what they do. So we use that international firm to partner with us and give really good advice to our clients. So today's agenda, as you'll see on the screen, we're going to go through bonding, we're going to go through valuations, and we're going to go through time to pays and some of the technical nuances that we've encountered in some of the advisory work that Dan and myself do for our clients. I don't know, for those of you that listened to the news this morning, there's a lot going on with accommodation providers who I believe are lobbying towards the increase in business rates that are coming up in April this year. For those of you who recall, during COVID, business rates were reduced for the hospitality sector. But like I say, that's due to come to an end. You'll see on the screen, you know, examples of what's gone on in the public domain. So with Whitbread, you know, they've had to close more than 200 restaurants. The hospitality sector itself has been among the hardest hit by financial distress in recent years. And the examples that we have on the screen, like Whitbread, brands also like Beefeater, Brewers Fayre, affecting 1,500 jobs alone. And we've got the retailers as well. So it's not just hospitality. Beyond hospitality, we have high street retail that saw over 800 branches close amongst multiple brands, and grocery delivery firms also led to a lot of jobs. There was 1,500 job losses in the UK alone. We also had challenges with breweries. They faced significant challenges, with 26 of them becoming insolvent, signalling stress in the craft beer sector. And these are just a few examples of, that illustrate the low cost pressures, the changing consumer behaviours and high fixed costs that have created what we would call a perfect storm for business reliant on discretionary spending, and looking at footfall, etc., of what's going on in around the arena. Again, we've talked about, well, I just mentioned hospitality and retail. Construction remains one of the most distressed sectors, with over 97,000 businesses facing significant financial challenges. They've got rising material costs. There's a lot going on. We've heard about Trump and his tariffs. It affects these businesses trying to import and export in the construction industry. Supply chain disruptions. We've got labour shortages that have compounded the problem. And many construction firms depend on bonded projects requiring performance guarantees, and financial distress often limits their ability to secure these bonds, jeopardizing contract fulfillment. Support services and real estate sectors also report tens and thousands of distressed companies, reflecting broader economic strain. And we've got the same in technology as well. Where the distress frequently derives from over-leveraging after venture capital inflows, market corrections and cash flow crises. And these are despite high initial valuations, where some tech firms have entered into insolvency with pre-pack administration, enabling asset sales to satisfy creditors. We're going to talk about that a little bit as we go along this morning through this presentation. We've also got transport and haulage companies facing unique pressures due to fuel dependency and debt financing, rising interest rates and economic sensitivity to fuel costs have pushed firms into administration. Bonding requirements in transport, such as for public or commercial shipments, add another layer of complexity. These sectoral examples underscore the diverse causes and consequences of financial distress across industries, highlighting the interplay between operational challenges and contractual obligations.
So a lot of these will be probably very familiar to you all with regards to sort of key drivers of financial distress. They've really come to the fore during the COVID and the post-COVID eras. And really, there's a lot of talk about rising debt levels, government debt levels, which causes sort of fear in the economy, the geopolitical landscape, which sort of leads to lower spending from the consumer across a number of different areas. That largely hits as a lot of the sectors that Sandy was talking about. I will talk later about case studies because they're nice to listen to for everybody. But where you sort of mainly see it from our point of view is high street, or anybody linked with a high street, construction, hospitality, and they all come from these areas of rising cost pressures across sort of energy bills, higher wages, which can be just literal higher wages, and also some of the matters regarding tax, with sort of employers' national insurance being one of them, which obviously all squeeze the profit margins. Without sort of getting political, it's probably not the employers' national insurance is not necessarily the wage increase or anything to do with wages, as we're told, but it does have obviously significant effects on companies and their spending ability. Consumer spending shifts, as I've mentioned. I've got a lot of sort of live examples of lower spend in hospitality. What does that mean? Where's the spend going? How do different businesses have to sort of move with that time? Strategic decisions they have to deal with. And then the other bits, probably some of the other bits which are not sort of regularly spoke about with regulatory and sector changes. Certainly in our sector, there are regulatory changes to us all the time, which increases the amount of people we take on, and how that all sort of interplays with each other, and it sort of then feeds that cycle of rising cost pressures again. And that is where we see a lot of those sort of financial distress businesses coming in because of these sort of four main areas. Again, it's probably not rocket science, but these are the early warning signs of distress, where we see it in a lot of our sort of live client base, where there's little government support, little access to debt, which doesn't help with cash flows, and leads to cash flow strain. So reliance on some of the facilities they've currently got, but also the goodwill of their suppliers in making those delayed supplier payments. But as we know, suppliers get a bit sort of itchy feet, and they don't really like being sort of lent on, which then sort of causes a number of knock-on effects from that. Once you have that, you may have falling client numbers. You may have issues with retaining staff. You have the rising costs, which I've just talked about, the debt build-up within the company, and there's just a sort of spiraling effect of a number of areas happening, which, if you get it at the early stages, you can see it, and if you've got your sort of forecasting, which I'll come on to later, but these are certainly sort of the earlier areas, the early signs, sorry, of distressed businesses.
Okay, so we talk about bonding. So, Dan's mentioned, a lot of factors that can lead to a business being in a position where it is required to take bonding out. And we know that loss of bonding can result in contractual losses and worsening the financial position of a business. So this needs to be done with due care. And also, as you see on the slide there, the bonding can add the legal and financial complexity to a business, and it can get quite difficult if you've got too many people doing separate things. We all need to come together, understand what the business is actually trying to achieve, and then work together to produce something that's going to work for both the authorities, HMRC, and the business itself. And, we've talked about the financial distress. So we know that financial distress is where a company is experiencing, financial difficulties, the inability to meet its debt obligations, declining cash flow, or operational challenges that threaten its viability. These conditions often lead to businesses towards like a business recovery scenario, but that's where we can help with our experience, where we would liaise with HMRC to ensure that what we're doing is right for both parties, as I've mentioned already. And, we talk about construction projects, and, within construction, there is, bonding, performance bonding. So as soon as a construction project has finished a particular stage, then they can move on to the next part of that construction work. But, when a company's financial health deteriorates, securing these bonds becomes increasingly difficult because, we're looking at the health, we're looking at the financial viability of the business, and adding another layer into this can actually be quite difficult. There are various types of bonds that I'm going to talk about in a moment. And from a VAT perspective, as you see up there on the screen, there is a notice of requirement that is issued, and it's covered by Schedule 11 of the VAT Act. So you have the notice, and then I will talk to you about what the types of bonds are. So bonding, when we approach HMRC, they will ask the general questions that we see up on the screen. Has the business had VAT arrears? Now, when I've been faced with calls with HMRC, we do need to look at the history. HMRC normally go back 4 years. Now, during that time, if a business has had arrears, we need to be able to explain to HMRC the rationale behind that, what happened. And in most cases, those arrears are an oversight, they're just a hiccup, and it's nothing major. So as long as we can get across that first hurdle, we then move to go on to the various points. So again, you know, if a director has had previous compliance issues because they've been a director of a business that hasn't complied with not just filing VAT returns, but the payment, we're also talking about other taxes. So we talk about PAYE, corporation tax, etc. So any arrears, any compliance issues for taxes, we need to be aware of when discussing with the authorities, that we can manage and we can position this, as I say, for both parties. Where businesses are requiring bonding that have been through an insolvency process or a pre-pack, again, we need to understand what's led to that insolvency, how that pre-pack was handled, to ensure that we are not missing anything. And again, I'll talk about that a little bit later on in this session. Where HMRC believes that the company will not meet its future liabilities, you know, Dan mentioned cash flow projection, we will get involved in that. We will do it from a VAT perspective. And if HMRC do believe that the company are not going to meet its liabilities, we've got on the screen there VAT, but we are talking about the majority of taxes. They will not accept bonding. So we need to make sure that we understand what has happened historically and what we're going to do going forward. And the last point on the slide that is very sort of unknown to many people, when we're dealing with VAT, there's a lot that gets dealt with under the civil route, but it's actually a criminal offence for businesses to trade without making a payment towards the bonding. So they work simultaneously, and again, cash flow will come into play on that. A surety bond, again, it's a specific type of guarantee, a specific type of bond. We've talked about performance bonds, and these are normally held by banks or supported by banks instead of a cash payment having to be made. So the bank or the insurer will guarantee that it will pay the VAT debt if the business defaults. Those are quite difficult to get, but with some of our clients, they've got very good relationships with such providers. Of course, it comes with a cost for these banks to provide that guarantee, but nonetheless, it is available. When the income comes in, say the actual bond itself, it will be dependent on whether or not it's the insurer that has provided the bond, and the VAT treatment of that will depend whether it's the bank or the insurance, leading to a VAT exempt supply or a standard rated supply. So do not forget that there's that loop to close. When you get the money, we need to look at the VAT treatment of that income as well. So moving on to security bonds. So we're looking at potentially companies that are leading into insolvency, and those that have had poor VAT compliance history. As I've said, it's not just VAT, we're talking PAYE and corporation tax. So we need to understand the payment history and the compliance for the business. Again, we look at the directors. So directors could have moved to businesses, but they could have been directors of a previously liquidated company. And if they've got unpaid taxes, we need to understand the reason. Those reasons could be quite simple. They could be quite factual and things that have made VAT to be unpaid. We had a case where, unfortunately, the accountant was quite ill and eventually he passed away, and the director, that company got liquidated, but that was a good excuse and one that we could justify with HMRC to talk about this director, and we could move on from that because it wasn't something that was self-inflicted. So we talk about HMRC, they do categorise the types of businesses, they categorise them as high risk if we've got you know, we're ticking the boxes that we've got poor compliance history. We've got directors that have got a number of businesses that they've liquidated, and understanding the reasons leading towards the position they're in. And also, as the screen shows, the bond is the director's personal liability. I have had calls from directors of businesses standing in their pajamas where we've got HMRC coming knocking on their door. One director owed 78 grand, and he was on the phone to me. He had HMRC at his door trying to distract goods, and he wasn't aware that he was personally liable. So please take care. In the majority of circumstances, directors need to ensure that, you know, what they're doing and they cover their own responsibilities. The bond itself does not reduce the amount of VAT owed as well. This is only a deposit or a guarantee that HMRC are seeking as security, whether that's from the business or whether it's from the bank or the insurers. And the VAT returns and the payments still need to be made as usual. And again, I'm going to mention that failure to pay the bond will lead to a criminal offence. So HMRC's use of bonding, normally when we've got businesses that are either going into or exiting some kind of procedure or a pre-pack, HMRC do look at companies that are phoenixing. So we've got companies that have, as it says, you know, they've gone underground, but somebody, the director, likes to resurrect a similar company. And HMRC do look for this, and they do see this. And if there's a phoenix company that is resurrected, and historically it's had unpaid VAT, HMRC are not going to look on that one favourably. So we need to come up with really good rationale, robust cash flows, and a really good, robust business plan to ensure that HMRC are going to look a little bit more favourably than they have done. So it's all about knowing the business history and what we're going to do going forward. The consequences of bonding do add to cash flow pressures. So we've done this historically where we take that into the forecasting and make sure the business knows that it can pay what it is liable to pay. There is obviously the possibility of the requirement of external financing to pay the bond or to pay the VAT, or however the business needs to manage its flow. And again, with that external financing, I think Dan will echo what we do as well here, is that we have to provide cash flows and business plans to the external financiers. So there's a lot to do to get to a point where we can get these businesses out of a predicament and up and running. And as it says there, the lack of bonding can halt trading, and it can, you know, sort of derail the rescue attempts and all the hard work that we put in. Because if you don't have bonding in place, HMRC can actually prevent that business from trading.
So how do we help clients with their cash flows? There's a lot of sort of SMEs out there who may do a cash flow at the start of the year, or may do some sort of forecast at the start of the year, and then put it in a drawer and never look at it again. And I think that a few years ago, speaking to a client who did do that, we sort of likened it to having a map at the start of a journey, and then setting out the map, and then putting it in the drawer, and then setting off in the car or the boat or whatever, and never looking at the map again. And that doesn't invariably go very well for anybody. So people need to sort of constantly look at their cash flows, especially when they're in distress and those sort of signals happen, and when you're entering into new finance arrangements, to make sure that the business can afford to pay its debts as they fall due. So we will work with clients on their projections, looking at a number of different sort of simulations and assumptions, inputs within that model regarding growth rates or maybe maybe sort of decline before it gets better. Interest rates that are looking to get, some sort of timing. Again, what's also lost on a lot of clients is they'll do maybe a profit and loss account and presume that that is their cash flow, whereas I think a lot of people maybe in the room know that that is not the case. So the cash flow is usually quite different to the profit, in a number of instances, VAT being one of them. So getting that timing right of a number of things, and when your debtors are going to pay and when your creditors are going to be paid, all of those things will all into play, and lenders will expect you to have some sort of integrated model of a profit and loss account, a balance sheet, and a cash flow. Where we have helped clients before with a sort of a live example is, as I say, a funder or a lender, whether that is a friend and neighbor or a bank, probably a little bit more sophisticated if it is a bank, but they will require probably some level of financials. And where we sort of step in and add that credibility is to provide that that level of credibility. And one such case is where we had a business which was over in multiple sites, and they needed some funding to sort of get them out of their hole that they were going into, and the bank sort of came to us and said, we want to engage you to report to us on the funding ability of this company on the current terms that we've got with them. So we had to sort of report to them on the post, present, future, including the assumptions and the fairness, reasonableness of those assumptions and the future forecasting that was presented to them. So what do? We obviously look at the future assumptions made, and say, for example, if they were sort of going off the chart, saying they were going to turn over 100 grand a month in about 3 months' time, but at the last 12 months they've been doing 50 grand a month, we have to sort of be digging into the whys and wherefores and reporting that to the external lender. We have to obviously plug sensitivities into that analysis to inform the lender of levels of sensitivity. Was it sort of 1% sensitive to mean that they couldn't pay their debts when they fell due if it just sort of went off a little bit by 1%, or was there some sort of 20% sensitivity built in there? If the current model and the current results could be used, and what sort of level of confidence do we get over those current numbers that could be used in the future? What would be the breakpoints in that? How would taxes be paid? How would lots of other creditors, what sort of terms are they using? Were they the same terms? Was there any sort of special function in there? And we sort of reported on that, as I say, and it wasn't necessarily that the first projection that was given to us was the one that was finally landed on. There were a couple of iterations of it that we sort of helped them on, although it was very much their projections, and we sort of steered them through that to make sure that they could give it to the bank. But it turned out to be a positive outcome, but it was very much us working with them and making sure that it sort of was right for both the lender and the company. Sandy will talk now a little bit about sort of VAT arrangements and working with the VAT in those forecasts, and any sort of specifics that sort of come up in those.
Okay, so thank you, Dan. So I think with, sort of continuing on from the cash flow, and, there's a lot of VAT here, but as I've mentioned earlier, it's to do with taxes. The reason VAT is playing a very strong part in all of this, I'm not sure if anybody's aware, but when we look at the revenue that's generated by HMRC, the most recent figures show that VAT generates £172 billion. Corporation tax is coming at about £90 billion. So you can see the importance of VAT when it comes to structure, cash flows. The reason that this is quite high, I'm assuming, is because there's a lot of penalties, there's a lot of interest that HMRC can charge, and there's a lot of businesses out there that think HMRC are right and they don't question it. And I think that's a challenge in itself, that the authorities are not always necessarily right. But you know, that's another subject for another day. What we are going to look at are time to pays, which I am going to come on later on in a little bit more detail. But you know, it's to reiterate that we need to prepare cash flow forecasts before contacting HMRC. We need to get hold of HMRC as early as possible. I'll give you an example after this slide of something that I've been involved in. But you know, typical time to pay runs from about 6 to 12 months. It is extendable. HMRC have now changed their approach, where they used to have time to pays that were longer than 12 months, but they're digging their heels in, and it is difficult to get time to pays for longer than that 12-month period. HMRC do expect honest and full disclosure, and you know, if we are setting out a time to pay, they do expect those future liabilities to be met. We also need to understand that, you know, any wrongful trading accruing further unpayable VAT is not going to work. We've got insolvency practitioners notifying HMRC because VAT does continue when a business is in some kind of administration. The VAT does need to be dealt with pre and post that appointment. And we also need to make sure that there's a really good understanding of the VAT rules on disposals of assets and transfers of going concern transactions. A little one that I was dealing with, we were dealing with a client that was selling precious metals. He didn't realise that he needed to be VAT registered. He should have registered about 5 years ago. Now, there is quite a lot of money involved, as you can imagine. And what we ended up doing with HMRC pre and post Christmas was agreeing a very long time to pay, because not only did we have to submit his first VAT return covering that 5-year period, we had a failure to notify penalty to calculate. The client was partially exempt. So there was a lot of nuances that we had to go through and a lot of hurdles. But because I've been working with that business for about 3 years now, we knew this business inside out, and to get the time to pay arrangement that we got for them was absolutely amazing. And the client was really, really happy. You know, sort of going into Christmas, giving him that comfort that we had such good knowledge, we were able to position this with HMRC, and his time to pay starts at the end of this month rather than what was supposed to start about 3 or 4 months ago prior to Christmas.
Just a few points here, just to be conscious of time. So just going to run through a few points on the impact of bankruptcy with both you as an individual or individuals who may go bankrupt, and also the company behind them as well. With regards to the individual, there can be sort of legal ramifications on them holding positions like directors and trustees in the future. They can obviously have challenges in being hired and having to disclose that with any future employment, but also on the business behind them as well. There is an effect on the workforce. With the business being bankrupt, you've got to have job losses. There is that reputational risk as well with regards to that company and yourself in the market, and you know, just sort of general industry shifts, and employers sort of then face the trust in rebuilding themselves and the brand after bankruptcy. So it has sort of a double effect on the employment side.
And coming back to sort of bankruptcy and VAT, again, VAT does come into play here. And what we tend to go through from a VAT perspective is ascertaining what that final VAT liability should be. We look at whether or not the VAT registration should be cancelled. There are occasions where a VAT registration may not be cancelled if we're selling personal assets, and we want to make sure that when we sell those assets, we're doing them at the sale value rather than market value, because market value can create a higher value for a dereg perspective and create another liability, which we don't want to do. Changes in bankruptcy. So, we don't do online VAT returns. There are paper VAT returns that need to be submitted, mainly because bankruptcies, they will be facing distress, passwords, logins, things like that wouldn't be accessible sometimes. So HMRC do provide these easements to produce and submit paper VAT returns. The issues that we can have with bankruptcies are the delays. So if there are VAT repayments that are due from HMRC, they are going to check that this is a viable, and that can take quite a long time to go through with HMRC. So when we're trying to liquidate companies or strike them off even, these repayment delays can cause problems, but there are ways around it by either assigning that repayment to another entity, which needs a bit of handling and management. We need to also be careful where there's VAT groups in place. So, it may be just one part of the VAT group that has gone into a bankruptcy, and we've got to be careful of joint and several liability when it comes to VAT groups. We've also got bad debt relief that comes into play. So, if there is bad debt, so if either we owe money or money is owed to us, let's make sure that that's managed from a VAT perspective. Again, that's very often overseen. And then we've got to look at Crown set-off. There is taxes that are subject to Crown set-off post-appointment. So again, if debts get unpaid pre-appointment, we need to manage that to ensure that we're not trying to claim more VAT or offset corporation tax against payments that haven't been made. And I've talked about bonding, but the time to pay arrangements are quite important. And I'm going on to those in a little bit more detail next. So, time to pay arrangements. A time to pay is to collect VAT. It's an agreement with HMRC for payments to be made over a period of time. And like I've said earlier, maximum is 12 months. May get a little bit more than that, but it just depends on the circumstances. HMRC would normally issue a letter setting out the payment dates and the amounts that are to be paid. Time to pays are generally done on a case-by-case basis. They're done when businesses can't pay the VAT, but the business must be able to afford those proposed instalments and meet their ongoing compliance. It's no good to sit here and say, yes, we're going to pay 10 grand every month to, over the next 10 months to meet 100,000 liability, because we've got to factor in the fact that other VAT's going to be due during those periods. So, as Dan's mentioned, as I've mentioned, these cash flow forecasts and projections are really, really important. We worked with a group of companies that basically did a restructuring. They put all of their entities into a VAT group. They did not realise that by consolidating, their VAT liability was going to go above the 2.3 million threshold that made them a payment on account trader. And that hit them very soon after they'd done this restructuring. And they came to us after they'd sought advice from somebody else. So that was a bit of a pickle to undo. There is the option to call HMRC over the phone. So where that VAT debt is less than 100 grand or 100 grand or less, you can do this online. And you need to ensure that the VAT return for the period that you're asking for a time to pay has been filed. Because if HMRC can't see the value, they won't agree a time to pay. Doing a time to pay, HMRC normally ask if there's no other liabilities, no other debt. So it's not just VAT, they take into account PAYE, corporation tax, etc. And doing this online is only relevant for VAT periods after 2023. and they do require payment within 12 months. Anything else is an over-the-phone job. I'm not going to go through all of this, but there are requirements for time to pay. So you need to make sure that liabilities that are coming up are paid. With a time to pay, if you get there in time with HMRC, there won't be any penalties, but interest will still be charged. So, sort of wrapping up slightly here, what we're talking about with distressed businesses is to identify and establish the current VAT position. We need to look at the history. We need to look at what we're going to do going forward, and we need to look at the cash flow going forward. There's loads of VAT schemes that are available that will help with it. We've got cash accounting, which is good, for very cash days, but bars, hairdressers, so they can use cash accounting scheme. The annual accounting scheme, I don't really like this, but for smaller businesses, it's a way to do payments on account during the year and then just truing up your VAT at the end of the year. And there's a flat rate scheme for some businesses that can pay just a flat rate on their income. They don't get to recover the input tax, but the flat rate accommodates for that. And it's a very simplified and a nice way of moving forward with VAT accounting. So what we do as well with our clients is we look at the signals. We look at their VAT accounts, we look at increased suppliers costs, we look at decreased consumers, and we manage the VAT so we can set up the codes in their system to capture all of this in a really good manner to ensure that their VAT runs really smoothly. We know about late filing penalties and default surcharges. Some of them we can argue, some of them we can appeal. There are, the risks of incorrect classification, and these are more for the sectors. So, if you're classifying catering incorrectly when you're actually delivering food, you can have a 0 rated supply versus a standard rated supply. So all of these nuances we can tease out. And with the construction industry scheme, CIF, that is one that we could do another presentation that will probably last a day on, with the VAT accounting that needs to be done by either the supplier or the consumer, and a lot of mismatches going on within that industry.
So the second string to my bow in the sort of advisory world is the sort of valuations of shares and assets within entities, which is quite topical for companies, businesses, etc., going into a process or hopefully trying to avoid a process, and therefore it's for the benefit of the administrators should a company sort of sadly go into administration, or for the creditors and the buyer's protection. So a number of times that the company will have some sort of asset, might be goodwill, it might be some sort of intellectual property right over something, or something physical, like a property or whatever. But it is sort of, it's very important, obviously, for the administrators and the creditors and the company directors, if they want to sell that before it goes into a process, to have a professional valuation of that asset, so that any asset undervalue claims can be minimized or sort of waived off by those administrators or the previous directors for creditors and for buyers before it sort of comes out of the process. So just sort of one example of that is we had a case that a director sold the business from the company before it went into administration. It was quite clear it was going to go into administration. It turns out he sold it to a friend or something similar. So as you can imagine, the value was quite low, went to administration. After a number of years, the administrators finally decided to have a look into this and appoint myself as the valuer to value the asset. It clearly was sold at way below market value. I actually went to court. I was a witness in court, But obviously, a number of years after the event, it becomes quite difficult to get hold of those historical documents. Certainly, if a director who's not playing ball and who's done something a little bit dodgy, he's probably destroyed a lot of those documents. So it's better to get all that sort of stuff in place at the time of doing it, and that is certainly something that I deal with. Sandy will talk about sort of the issue of sort of shares and assets within companies, disposing of them from a VAT perspective.
Thanks, Dan. I think, sort of carrying on from that valuation point, Dan, and it's a really, really good point, and one that catches many businesses out, and it's deregistration. So when you deregister for VAT, there is a requirement to account for VAT as if you've made a sale of assets where the VAT would be £1,000 or more. Now, we had an example where the value of assets, market value of the asset, for one of our clients was about 100 grand. And we were toying with deregistering, do we remain registered? Market value was the 100 grand. But, we know that when businesses are, in a bit of distress, they may want to sell their assets a little bit quicker, and therefore not for the 100 grand market value. And in this case, we had assets to the tune of about 80 grand, and they were below the VAT registration limit. And what we managed to do was deregister the business and actually sell the assets without VAT, which was amazing for them at the time, but something to be, look out for when we are deregistering. It's the market value that we use, but it's actually the sale value that's going to dictate whether or not you need to deregister or register, especially when you're on that borderline. And it sort of leads on to that timing and the assets to be sold. So, when are we going to sell the assets? Do we sell them while we're registered, or is it better for us to deregister and sell 50 or 60 grand of assets without having to charge VAT, because we know that the person looking to buy them is VAT adverse themselves? So looking at the bigger picture there. We often come across pre-packs, and those can be really difficult. So we need to be very careful with VAT registrations. We do not normally recommend taking on a business's VAT number, because with it comes the historic liabilities, and we all know what that could bring. So we would always recommend that a new VAT number is taken out by the new owners, especially when it's a transfer of a going concern. And we also need to be careful where there's options to tax over properties in place. Those options to tax are there for the vendor, the supplier, and the options to tax do not move to the buyer of a property, which again is a very big misconception. And in pre-packs, we do tend to find a lot of barter supplies. For example, you'll have an empty property and you'll say to somebody who is interested in buying to occupy that property, they get a feel for the business, they may start wanting to move stuff in. But actually what they could be providing are security services. So instead of them being charged rent, you get these guys to stay in the property, but actually what they're doing is security services. They're in the property to make sure that nobody goes in and squats or ransacks or tries to take any of the assets out. So be very, very careful with that. The options to tax with properties do arise for most transactions. So we're talking about commercial property, residential properties that may be held. And for any properties where there's an option to tax in play and where we've got a transfer of a going concern, be very, very careful with a capital goods scheme, because in buying a business that has a capital goods scheme asset, i.e. land, property that's over currently 250,000, the acquirer may need to look at the use of that property to understand whether or not they're recovering the right amount of VAT at the right time.
So just a few things to think about maybe when a company has sort of come out of the process, who owns it, in what structure. Just very briefly, from an audit position, there are size thresholds to concern yourself with. So how big is the company, but also how big is the group that it may now be in. Just to let you know about, a few of the thresholds. Current thresholds for an audit: 10.2 million turnover, 5.1 million gross assets, 50 employees. That is 2 of 3, going up to 15 million turnover and 7.5 million of gross assets and 50 employees. There's some other services that you need to be as well that disappeared from the screen, but I'll you've got your accounts computation to be preparing. You've got to be doing your tax returns, VAT returns, payroll, all those sort of great things as well, which we offer at Gravita. Just on the audit side of things, though, not only are the size thresholds important, but also maybe what industry are you regulated, what are those legal ramifications of that, but also we see it quite a lot where a new lender might come in, and one of their stipulations is the company needs to be audited, regardless of size or industry. So that's something to be aware of, but also the lender, irrespective of an audit, it might ask for the certain covenants to be certified by an auditor as well as part of the funding pack. So just to bear that in mind as well. And as I say, monthly, quarterly reporting, feedback to lenders, investors, it's something to be considering when you are receiving that funding.
Yeah, and I, sort of going on, talking about VAT returns and reviews, so making sure that we are compliant. I mean, we're just reiterating what we just said. Apologies, my laptop died and we've had to reboot, so I'm really sorry about that. So, compliance, I've talked about VAT. It's not only VAT. We need to ensure that, corporation tax is up to speed, payroll, or all of the tax obligations, PAYE, is all done, and our CoSec filing obligations, at Companies House, all of that is met, because these are the areas that HMRC do look at, and they will question this when we're trying to get any sort of arrangement in place with them. And I think, as you see on screen, the practical tips there. So when we're looking at financial distress, or we think that's something coming into our business, make sure you've got the right people there. We know what we're doing at Gravita. You've got your own accountants, but make sure these people are actually working with you, understanding your business, understanding where you want to go. And Dan and I have both mentioned the, forecasts. These are key to what we're doing, not only just for the history, but also going forward in time. Have somebody that's able to talk to your suppliers. I mean, Dan and I are well versed in speaking to HMRC. And it is difficult, and sometimes you've only got one shot at agreeing a time to pay with HMRC, so you need to have all your ducks in a row to make sure that they know your business inside out. I've had a time to pay with a fish and chip shop chain, and I was on the phone to HMRC and they said to me, oh, they've got this outlet in wherever it was, and I was on top of it, and I said, oh yes, well, they've got that on the market. If it does come to fruition, then we'll sell that and we can pay more under this time to pay arrangement. And HMRC were quite pleased that, we'd been looking at other ways of satisfying this debt, not just meeting the time to pay, but actually trying to settle that time to pay sooner rather than later. So, as it says there, having a chartered accountant does add credibility to this. And we've seen with VAT that, if you're looking at trying to agree something with HMRC, having a VAT advisor actually helps mitigate penalties. So there are lots of options there, and we've got a lot of professional people that can help with the nuances that we need to go through. So I think sorry, go on, Dan, you can do this. You go.
just some of the summaries that we talk about today. So we spoke about some of the sort of financial distress factors that you might see within a business model. You might see some early warning signs from those distress factors that we spoke about. The strategic responses which you can have. So, you know, the forecasting, the discussions you can have with professionals, the discussions you have with suppliers, the discussion you have with the HMRC on the various taxes. And then, you know, you have your own individual corporate actions which you take from that regarding employment, regarding some sort of cost-cutting measures, maybe just a different staff mix of how things are happening, and obviously from the bonding points that Sandy was mentioning earlier.
So, you know, we've got some key takeaways up on the screen there. So, and, you know, I won't go through them point by point, but, you know, for me, when we deal with businesses, it's really understanding what they've done and how we can help them going forward. And, you know, we've worked a lot with business recovery and looking at structures, looking at, you know, reorganizing things. And it's not just VAT, it's looking at the bigger picture of all the taxes and making sure that we are addressing all these points that need to be managed effectively to ensure that the businesses that we're helping get a really good deal with HMRC to enable them to continue whilst working with the authorities in the manner that we do. Right, I think we're sort of nearly up against, well, we're up against time, but we're more than happy to take a couple of questions, if there are any. Double checking.
There is one in the chat room which just says, "Got late. Is this being recorded?" I think it is, isn't it?
It's being recorded, yes.
Yeah.
It is being recorded. I think, you know, there's another question. Sorry, can you? Okay. So, well, hopefully there's not questions that are coming up, but hopefully we sort of covered the breadth of what we do, not probably the depth, but there's quite a lot of nuances, as you can tell. But I hope you found that useful from a Gravita perspective. Over to you, Johnny.
Fantastic. Thank you very much. Just a very quick thank you to the Gravita team there for a very informative session this morning. Thank you very much to everyone that's joined, and we look forward to seeing you soon. Again, if anyone from the Gravita panel wants to hear more about TMA, please, my details aren't on the screen, but I'll put them in the chat now in case anyone wants them. Please do get in touch, and yes, I'll get back to you. Thank you very much.
Thank you very much, all. Cheers.
Thank you.
Thank you.
Have a good day.